try and join. Try and check us out at prosperus.asia, if the QR code in the top right. And there's lots of different rewards up for grabs if you do open an account and fund it. So please do check us out. Okay, and obviously this is part of the CGS-CIMB Driven to Learn campaign. So I'm just gonna play a quick video to show the viewers here tonight how you can potentially win a Tesla.
Think you're driven enough to succeed?
All right, great. So
Think you're driven enough to
without any further ado, I'm going to pass it off to Andrea, who can take you through the earnings.
Thanks, Tim. Just let me share my screen. All good? Just check, is my screen showing up all right? Just to double check before. Okay, cool. Thanks very much, Tim. Good evening, everyone. Thank you for joining us today. As Tim has mentioned, today I'll be going over the third quarter earnings of Singapore banks, giving a breakdown of how they've done over the year, and also we'll then dive into our outlook for the sector going into 2022. We will be covering the trends that we are seeing as well as potential headwinds that could come up. So to start off, I think it will be useful to go back in time to the early part of last year to give some context to the operating trends that we are currently seeing. In the first half of 2020, that's when international borders started to close as COVID-19 infections rose. Effectively, the pandemic that disrupted global economic activity and the US Federal Reserve, they cut the Fed funds rate by 150 basis points to essentially zero. And we have been in this low rate environment ever since. As you can see in the figure on the right, the downward sloping lines, that shows the quantum of how much benchmark rates of SIBOR, SOR, and LIBOR, how those have reacted since the Fed first cut its rates in 2019. And in tandem with those rate cuts, the net interest margins, or the NIMs across the banks, they've narrowed about 22 to 49 basis points over the past 2 years. Although the bright side of this is that NIMs have more or less stabilized at around the 1.5% range as those benchmark rates hover close to zero. If you can look on the right-hand side axis, sorry, the left-hand side axis. The closure of borders, that also had severe implications on loan growth, resulting in a contraction over the majority of 2020 as both consumers and businesses alike, they held back on investments, purchases, and acquisitions. So just waiting on a return for the ability to do business freely without the restrictions of distancing measures, as well as for a rebound in sentiment. As a result, banking system loans that did compress slightly in 2020 compared to the 4.8% year-on-year rise that we saw in 2019. As the COVID-19 situation improved somewhat towards the end of 2020 with the development of vaccines and that being rolled out, we did see some of that pent-up investment demand come back to market. And that's what you see in the particularly tall bar in the figure on the left, showing stronger loan growth coming in January 2021. And with this rebound, we are set to see loan growth coming in towards the higher end of the single-digit range across the three banks. So we're looking at about the 8 to 10% range for this year versus the up to 3-4% that we saw last year. And this number could even exceed that 10% range depending on how the fourth quarter does. And perhaps a little bit about where the loan growth is coming from. From a geographical breakdown, it's really mainly coming from flows between Singapore and Hong Kong and China, as well as it's also coming from the bank's corporate client book. And this is for investments in developed markets such as Australia, US, and the UK. And these investments include data centers, student accommodation, and other commercial property. Mortgage bookings, those have also been strong. And with the rise in primary bookings, we should see the drawdowns progressively coming in over the next few quarters. So that should give some more support to loan growth. Now, moving on to the key concern of banks over the past 2 years. Most of the concerns were really centered around the asset quality of banks and their exposures across the board, whether it's to business banking, consumer banking, domestic or regional, all eyes were on the credit quality of the books. Firstly, there was the question on the impact of business closures themselves on loan repayments, and secondly, on the effects of government-led moratoriums across the regions. So for banks, Singapore banks, where they're operating in, is about half of the book in general is made up of exposures in Singapore, and then amongst them you have exposures mainly to mainland China, Hong Kong, Indonesia, and Thailand. So the loan moratoriums, these included the deferment of interest and principal payments, and generally lasted or was generally valid for 6 months to up to a year. And this broadly covered most individuals and SMEs which were in need. You had to show some proof of whether you had loss of income, business closures, but there was some form of aid that was applicable to this pool of customers. At its high, the bank's proportion of loans under moratorium that came up to 10 to 15% of the bank's total loan books in the third quarter of 2020. And with limited foresight as to how the borrowers would repay those loans, as in the capabilities of those repayments, even with the deferment of those interest payments, the banks had proactively set aside a large amount of impairment provisions in preparation for the possibility of those loans defaulting. These impairment provisions that the banks proactively took, they mainly came in the form of general provisions or management overlays. It is at the discretion of the management to set aside these potential buffers. In the figure in the middle, you can see that these lines, they spiked in 2020 versus the relatively low and stable levels that you saw in 2018 to 2019. So from the chart, you could also see with the dark blue line that DBS did provide for more of these precautionary provisions compared to UOB and OCBC. In comparison, in the chart on the right, that shows the specific provisions of the banks. So these provisions are specifically tied to NPLs that have been realized. Other than impairments for some residual oil and gas exposures for OCBC early in 2020, you can actually see that there isn't actually a particular spike that you saw in the general provisions across all banks. And this is especially over this year when some of the government support grants and moratoriums tapered off. So from an NPL perspective, things have remained relatively stable despite the picture that you see in the middle from the general provisions. But in saying this, it also meant that with a larger impairment expense, there would be a larger reduction in net profit for the year. And that is what DBS experienced relatively more versus its peers in 2020, just because of that larger amount of impairments that they've put in. fast forward to the third quarter of this year, with moratoriums across the region gradually expiring, total loans under moratorium have now come off to about 1 to 2% of total loans. So that's quite a stark improvement from the 10 to 15% that I mentioned earlier. Repayment levels, those have been healthy, with some portfolios even recording stable repayments for over 90% of the portfolio. The large amounts of proactive impairments taken in 2020, that amounted to about $600 million to $1.3 billion per bank. And effectively, this allowed the banks to ease off these high provisions in 2021. And that's why you see closer into 2021 at the tail end of those lines in the 2021 range, you see these lines coming off quite substantially. The chart on the left, that shows the bank's credit cost and NPL trends over different crises over the past 10 years or so. So if you take a step back and look at the impact of COVID on hindsight, Singapore banks actually did quite a good job in managing overall impairment expenses. On NPL ratios as well, we did see a slight uptick from the 1.5% range earlier in 2020 to about 1.6 to 1.7% now in the third quarter of this year. But overall, I'd say that the increase in NPLs, that has been relatively well contained, especially considering the larger geographical scope that the banks are now operating in. With this, we argue that the worst of asset quality pressures are over for the CIMB banks, and we are expecting a fairly low and stable level of credit costs for the sector going into 2022. So what is it that is making up for the reduced revenues from the lower NIMs and softer loan growth over these 2 years? There are two key drivers that are doing very well across the sector, which compensated for the lower net interest income, and that is the wealth management segment and treasury income. From the chart below, we've mapped out how wealth management income has moved upwards across the banks, and on average, you can see that the levels that they have been increasing at, they are consistent and they are going upwards. And for wealth management, this is mainly coming from stronger sales of insurance products as well as structured products. And particularly, if you compare the levels of these three banks, you'd realize that DBS and OCBC, though they have been growing at a much faster pace compared to UOB. This is the result of several acquisitions over the years. For example, DBS, they acquired the private banking and wealth management franchises of SocGen and ANZ in previous years, while OCBC acquired those of NAB and Barclays. So effectively, this raised the revenue contribution from wealth management more rapidly compared to UOB, which has taken a more organic route of growth. At the same time, the banks have been a bit more adept at navigating the financial markets, and together with the increased trading activity of their client portfolios, trading income has also been very strong and has been a key source of revenue compensation over these past 2 years. So putting the various trends that I've mentioned all together with the low interest rate environment and improving loan growth prospects as international borders open, a fairly stable asset quality outlook, which should translate into fairly low and stable credit costs. We are expecting a recovery of net profit across the banks by about 4 to 8% year on year, and they are moving steadily towards a pre-pandemic ROEs of 12 to 13%. Upside to our forecasts, this could come from earlier than expected Fed rate hikes. Currently, we have assumed that interest rates will only be raised in late 2022, And therefore, any substantial NIM increase would only come in 2023 once that has passed through benchmark rates and when banks effectively reprice their books onto those new and higher interest rates. With the Monetary Authority of Singapore having lifted the dividend cap on banks in this year, as well as CET1 capital levels staying at a very strong level. On average, they're at about 14 to 16% now, and also with asset quality concerns being more or less done with, we have factored in a return in absolute dividends for 2022 to pre-pandemic levels. And coming back to the impairment provisions that the banks have expensed in 2020, we're also keeping in mind that the banks have this buffer of $600 million to $1.3 billion to release or write back, so to speak, which may positively boost income. It just depends when the banks decide to release these buffers. Again, the timing of the release is entirely up to management, and hearing them out in the recent results briefing, I think the stance is more of keeping them in place until we're all well and sure that COVID no longer exists. So I think it will likely be beyond 2022. And this will also, again, depend on the transmissibility and the fatality of the Omicron COVID-19 variant and how this impacts the reopening of economies over the next year. With banks having outperformed the STI by 3 to 15% year to date, we have a neutral call in the sector, as we think that the near-term catalysts have more or less played out, with those being, as I mentioned, the removal of the bank's dividend cap by the MAS, and positive news flow on asset quality staying intact post-moratorium. The next thing we're looking at to re-rate financials is really when the Fed hikes its interest rates again. Our preferred pick for the sector is UOB as a relative reopening play. With Hong Kong and China having started up its business operations, the economy is moving again, and with it easing its social control measures earlier this year, much earlier than all the other ASEAN economies that we've seen, the SING banks have in tandem gotten a boost from this increase in business activity. But going forward, what we are looking at is a reopening of ASEAN economies, in particular Malaysia, Thailand, and Indonesia. And this is where UOB has a larger upside to gain, given that 70% of its book is in ASEAN. Of course, this includes about 50% from Singapore, but it is larger comparatively compared to its peers. And at the same time, we think that investors' concerns on the asset quality of UOB's SME book and ASEAN book, that has not proven to have happened. And we think that the overhang on this share price will eventually taper off. At the same time, valuations are also relatively cheaper than its peers at 1 times price to book versus DBS 1.4 times and OCBC's 1.1 time. We think that the gradual opening of ASEAN and evidence that quarter after quarter credit quality of its book has stayed solid, that should eventually close the gap of UOB with its peers. And with that, I'll hand over the floor to Tim.
Thanks, Andrea. That was very insightful, and learned a lot about the latest earnings from the big three. Okay, so I think while Andrea covered more of the specifics on the bank's earnings, I'm going to take a look a bit more from the macro side and maybe get people thinking about the long term a bit more, about where the banks are maybe heading. So I'll just share a few slides first off. Let me just share my screen. Okay, so I'm going to just quickly do the disclaimer. This is my personalized financial, is not meant to be construed as personalized financial advice for others, my own personal opinion, etc., etc. Okay, so I'm going to just cover understanding why winners win. So, I mean, I used to work at the Motley Fool. So David Gunner's a big proponent of talking about winning stocks, and winning stocks tend to keep winning, right? So if you think about the long term, I think we tend to be a bit more apprehensive to buy companies that have actually risen in price continuously, whether that's maybe, you know, year to date, or if that's over 3 years or 5 years. But actually the trend tends to be, you know, it follows the company's business and whether, you know, the fundamentals are working out. So in DBS's case, I personally, like, you know, full disclosure, I'm a shareholder of DBS only. I know a lot of people who buy all three banks. I know, you know, some people who just buy one bank. So I'm definitely someone who just wants to buy the leaders in specific sectors. And in the banking sector, for me, I think DBS really has proven itself to be the leader over not just, you know, 1 year, 3 years. And you can see here in this chart, up to the end of October, it's over the past 20 years. It's really outshone the other two banks. I think, you know, there are probably lots of reasons for that, which maybe Andrea can also help fill us in on. But for me, I think it's just because it's its size. It's, you know, it's the biggest one. It obviously has a big business in China, which I think helps in North Asia, in Hong Kong. So I think they got in early there. But if you think about the dividend growth as well, it's actually been more impressive on the DBS side versus the other two banks. Another point is they also pay out 4 times a year versus twice for the other two. So that's something, if you are relying on income and you like to see that come in regularly, then maybe that's something to consider as well. So yeah, so I mean, over the past year, 3, 5, 10, and 20, on a total return basis, and I think on a price change basis, yeah, it looks like, you know, DBS, I think, really is leading the way. So for me, if we think about long term, and if we're just holding these stocks, if we're just holding bank stocks to provide income and we want a bit of growth, but we want that yield, then we shouldn't think too much about trading on those types of stocks if that's, you know, a regular holding for us. So for me, I think DBS really proves itself to be ahead of the other two. So I'm going to touch a bit on what are the threats, right? So whenever I buy a stock, or whenever we buy a stock long term, you know, you can have your trading portfolio, and then maybe you can have your long-term investment portfolio. But if you have your long-term investment portfolio, I always like to think about, you know, we like stocks and we buy stocks based on fundamentals, and we really love the story, but we should also ask ourselves, what do we hate about this stock? What is the biggest threat to this business or to this story? Because, you know, oftentimes we tend to put on rose-tinted glasses and we don't really take seriously the competitive threats out there. And in finance, there is a lot of competitive threat now. I think in the past sort of decade, there hasn't really been much happening in terms of innovation, but that's really starting to change. And this is something I had kind of brought up on a webinar last week, just talking about, you know, the sort of disruption that you're seeing with digital wallets, with fintechs coming in. Obviously, with banking, it's a really difficult space to disrupt due to regulation, and all these other things are, you know, hard to surmount. But I think this is starting to change. So this is actually from ARK Invest's Big Ideas 2021 presentation. This looks at just, you know, on the left, the customer acquisition cost for financial products. This is obviously in the US, but I think we can kind of extrapolate some of this to Asia and just understand, you know, how much does it cost for them to acquire a customer, maybe on the credit card side of the business, obviously on the bank retail checking account side. And you can see in the US, at least, the digital wallet side is just unbelievably low. It's basically marginal, right? And then on the right-hand side, you're starting to see where is the most value for these customers who are actually in digital wallets. And you start to see and understand, at least from the sort of tech side, why companies like Sea and Shopee, if anyone's seen Shopee Pay around, you know, it makes sense for these guys to be building their own digital payment system to meet consumers at the point of sale, right? And so basically cutting out the credit card and the middleman. And in the process, you know, obviously we think Visa, MasterCard, I mean, to me, they would be big losers, but obviously the bank partners as well would be huge losers. So if you think about credit card partners, you know, DBS issues have many Visas, and so does OCBC and UOB. So I think card businesses are part and parcel of banks' business. So it's definitely something that is substantial. And so if you see offline, online commerce, I think one of the bigger threats for me, at least from a shareholder perspective, is that we might see some of these guys start to build out a bit more comprehensive either wallets or digital payment ecosystems, which can then start to threaten card businesses for the banks. And so how much does it actually make up for DBS? For DBS in the latest quarter, its cards business, made up about 18% of income, fee income, gross fee income on the gross fee level. So, I mean, it's not insignificant, right? You're talking about nearly a fifth of its total fee income, gross fee comes from cards alone, right? And so cards is a pretty substantial business. OCBC is, relatively better sheltered, with less coming from cards. And then obviously we have UOB, and UOB is, I think this is at a net level, is less. So I think these are some questions that we need to take into consideration when we think about where the competitive landscape is heading for banks, and how that's going to play out, I guess, over the next not like the next year, because I think next year they're going to be launching in Singapore digital banks, but I think they will take time to gain scale and to gain traction. Whether they do gain traction is still up in the air, but I think it's something that we should all take seriously if we are shareholders of any of these banks, 3 banks. So something to keep and sort of watch out for, I think, for investors. Okay, so I'm just going to quickly touch on an upcoming session that we have for technical analysis. If you're interested in using TA for trading, then please do check out this this informative session that we've got planned with Jake, our in-house TA specialist. And so, obviously fundamentalist, I'm a fundamentalist, but if you do want to add TA to your portfolio and to your strategy, then there's definitely, I think, a place in there for it if you have the time to apply it. So so please do join us for that. And then below, we do have a market outlook coming in January, and we'll be covering US, Singapore, Malaysia, and China, Hong Kong, with Seiboon, who's our chief investment strategist, Billy, who's covering Malaysia, and myself, covering Singapore, and then we'll have Samuel Siu from the China Solutions team, who will be covering Hong Kong and China. So please do try and sign up for that if you do see it out. We are still deciding on the date, but that's going to be sure to be a good session. Okay, so I think I'm going to stop there. Mine was just quite quick, actually. I just wanted to take a look more at the macro level. I won't bore you too much with slides, because there isn't much to show at the macro level in terms of slides anyway. So I think we should get to the discussion. So I guess we can start, Andrea, with what I had talked about, I guess, from the competitive level. Do you think these digital banks that are going to be coming to Singapore next year, do you think they are a serious competitive threat? And what are the banks doing to repel this?
I do think that they will put up a good fight. You have the likes of Grab, you have C-Limited, and if you take the example of what happened in Hong Kong when the digital banks came up there, competition was stiff. They were offering very good fixed deposit rates. The whole market was buzzing with just news of these new competitors coming in. But what you have to realize is that although they were offering 6% fixed deposits, they were really only for a select group of individuals, up to maybe $20,000 in deposits. So the pool that was available for consumers, that was small. And with that, despite the noise, the Hong Kong digital banks, they aren't taking up any large amount of market share just yet. We're 1 to 2 years on. So I expect the same to actually happen here in Singapore, in that there will be a lot of attention on whether it's credit cards, unsecured financing that they roll out, or even very attractive fixed deposit rates. But I think in Singapore, it could be a different ballgame, given that the likes of Grab, C-Limited, Grab especially, they may tie you down with the whole lifestyle ecosystem. You use their food delivery, you use their car services. What do you think will come through when you open the app? They'll ask you, hey, I have a personal credit line for you, no cost for the first 6 months. So it will be very attractive. But on the bank side of things, okay, the banks are very large. You probably will not see any large financial impact to the banks just yet. I do think that this will be a threat, but over the medium term, the banks will, I think, retaliate. You will see those rates being offered by them as well. But my personal opinion is that those rates won't last, just like how it happened in Hong Kong.
Yeah. No, that's a good point. I think at least on the deposit side, I've always thought that these digital banks, they're never really going to fully disrupt full service banks because there are so many component part of the businesses that full service banks use. But there's always the talk of, sort of like death by 1,000 cuts, where there'll just be maybe a specific digital bank comes in to do something, like I guess cards or something that comes in to do remittances, and takes away that business. So, I mean, beyond cards, do you think is cards to you a business threat in terms of the digital players? And beyond that, is there any other part of the business that you think could be threatened?
I think, like you mentioned, one part that could be disrupted could be the remittance part of things. That was a very obvious vertical that they could enter. But what's happened in the past few months, if you realize, Tim, is that the MAS, they have been partnering up with the different central banks across the region. In Thailand, they've partnered up with PromptPay, and with every other ASEAN central bank, it's in the works. So for Grab to enter this landscape of remittance and cross-border payments, the central bank has kind of beat them to it. So essentially, all of us can now do it. So you remove that from the equation. I really do think that for now, it's just the payments and the credit card fee income that's at risk. Loan payments, not so much. Of course, this will be an inroad if they penetrate your landscape enough. Like you mentioned, that's why it has 1,000 cuts. You just need that one ecosystem to really tie them down.
Yeah. Okay. No, that's interesting. I think from my perspective, when I think about the banks, obviously you want that yield, but you also do want some of that growth. So I'm obviously a fan of DBS. So when I think about growth, I think about their acquisition in India, and then obviously the Shenzhen Dual Commercial Bank acquisition recently, which gives them a bit more, I guess, access to the GBA, like Greater Bay Area in China, Guangzhou, that Guangdong area. So for me, I guess that's what excites me. So how does it pan out for like OCBC and UOB? What have they been kind of doing on their growth sort of paths to get people excited, to get shareholders a bit more excited about growth?
As you mentioned, DBS, they have been making these acquisitions that have come out in the news, so that's quite loud and out there. But for OCBC, I think what they're doing is really to strengthen their Wing Hang Bank franchise. So that's really their gateway to Greater Bay Area and beyond. So, I mean, with the entrance of their new CEO, Ms. Helen Wong, she does have a background of breaking into Greater China. She was with, if I'm not wrong, HSBC previously, one of the foreign banks. Forgive me if I'm wrong. So she does have the expertise and the know-how to bring a foreign bank into that part of the world. And she's been successful. She brought it up. She started that whole Greater China strategy there. So we are expecting her to do the same with OCBC. They already have quite good inroads in the Hong Kong side of things, where they bank the top tier corporates, but not so much the top tier corporates in China. So that's where and how Hong Kong is doing it.
Right.
UOB, on the other hand, they are going more for the ASEAN route. They don't really make large moves such as acquisitions like DBS, but they expand their offerings via, for example, Tomorrow Bank that they launched in Thailand and Indonesia. So it's a bit more organic for UOB.
Right. Okay. Okay, so I think we've got a couple of questions from the audience. So I'm just going to touch on one of them here. So if you look in the Q&A box, you can see, in your view, how will crypto and digital currency tokens perhaps impact the banking system? I mean, we know DBS has launched its own digital exchange, which it's, I think, housing under a separate holding company, right? So is this have potential for just DBS, or is it, do you think OCBC and UOB also might be thinking about launching, I don't know, I guess crypto exchanges or crypto products? I mean, how do you think this plays out?
I think that the other two banks there definitely is the potential for them to dip their toes into it, but very true to DBS's culture. If you realize, they are always the first to jump into it. So if you hear them out, what is becoming of your crypto platform? How is it going to be? To be honest, they're not very sure how they're going to monetize it. But in their mind, as long as I'm in the space, I can learn, I can be the first mover. So it's really trying to get a first mover advantage into the crypto space, whether it's taking a cut of fees just by you trading, or whether it's tokenization of whether digital assets or physical assets. They're just trying to make their mark in that space to say, hey, I am here. Don't forget me, I am here.
Yeah.
How will this change the banking system? I think for the moment, you won't see too much impact on their regular lending operations. But what they aim to do is improve the efficiencies in, for example, securitization, settlement, just using blockchain technology, just removing the manual processes. That first step alone could bring them a lot of cost efficiencies. So perhaps from a larger, or taking a step back, what could potentially happen is this technology could bring down their costs, their daily average costs, and in totality, you see cost to income ratios coming off eventually.
Yeah. No, that's an interesting point. Is there, okay, so I think maybe I'll kind of take this on and maybe see if you have anything to add. Are banks in China and Hong Kong trading at a lower price to book value, and is there any reason? Okay, so I'm from Hong Kong, so I've invested a bit in Hong Kong banks previously. I think the outlook in Hong Kong, obviously with the lockdown and COVID is not being ideal, and it continues to kind of be in a lockdown situation in Hong Kong because it obviously has to follow the China policy. Whereas in Singapore, I think it's starting to open up, so I think it's been a bit more of a maybe salubrious business environment in Singapore versus Hong Kong. In terms of China banks, for me, there aren't that many that are, I guess, trading at they're trading at appealing valuations in terms of price to book, but as I like to say, cheap is cheap for a reason, so I wouldn't touch them. I do think, there are specific banks, kind of like China Merchants Bank, which is, specializing in sort of wealth management in the GBA area, and it's got a really good execution strategy, which is just doing well, but I think they will be trading at a higher valuation. So for me, the Hong Kong local bank situation is not ideal. You have like Hang Seng Bank, BOC Hong Kong, HSBC, which has been an absolutely shocking performer over the past 10, 15 years. So I think my personal take is that if you are going to go into another country to buy banks, I probably would not go into China and Hong Kong, based on the business outlook there and just the bank quality. And we do have to remind ourselves a lot of banks in China are SOE, state-owned enterprises. And though DBS is government-owned, it's definitely not in the same vein as an SOE in China, which is they're levers for Chinese government policy. They do not serve shareholders, right? They don't serve shareholders. So I think we all know that. So for me, I tend to avoid those types of banks as a shareholder. Yeah, your thoughts on Hong Kong China banks?
I think you captured it right. They are cheap for a reason. I think the largest overhang on Chinese banks particularly is their asset quality. The numbers they report, firstly, I think there are many doubts in the market as to whether their reporting is up to accounting standards, whether, global accounting standards. And even if they are, or if they're not, do you trust the quality of their books? For example, they could be reporting stellar numbers, and then comes along Evergrande. Evergrande should have been something that was flagged up, but yet it still fell through the cracks. I mean, many banks were impacted. So this doesn't serve what China. This essentially proves the stereotype to be correct.
Yeah.
You trust their asset quality. Right. So I think that's the key reason why they're trading at a lower price to book.
Yeah, no, I agree. And I feel like it's not even been something that's temporary. It's not been something over the past year. I feel like it's been something over the past like decade. So, I think you really have to be very, you have to have like a lot of hope to think that's going to change, right? If it's been like this for about a decade, like my bet is it won't change anytime soon. So that's so yeah, I wouldn't advise that, but that's just my take. Okay, so we have another one on Singapore banks compared to, say, other markets like US, Malaysia, Australia. How do they compare against those types of markets? I mean, I guess from, I'm not a bank specialist, but my initial take is they're, very well capitalized. I think the capital buffers are good, and then their dividend sort of payout ratios are very healthy. And their loan books, I guess, are they're not super exciting, but they're definitely more exciting than maybe you'd find in, I say, Australia or the US. I mean, is that kind of in the right area? Am I kind of gauging that right? I mean, how do you view them versus like sort of other banks in other countries?
I think you are in the right direction. I think what Singapore banks stand out for is for their conservatism. If you're after, it depends on your risk profile really. If you're after a bank that no matter what, no matter rain or shine, you can go to sleep at night, Singapore banks are your best bet. I mean, this is in comparison to other emerging markets, Malaysia or the other MIST, Indonesia, Thailand. They're careful even, and this is evidenced by, firstly, how the banks have managed the past 2 years with COVID-19. Of course, this is helped by government intervention with the grants and moratoriums, but if you remove this, if you look back into the 10 years, during times of crisis, you don't see them being impacted by as much versus the other emerging economies. But then again, if you're a bit more aggressive, if you're looking for growth, Singapore banks might not give you the boost that you are looking for versus a pure play Malaysian, Indonesian, Thailand bank.
Right. I guess we've got another question. Okay, Hong Leong Finance, any thoughts on that? And banks in Malaysia, and I guess they've got a couple questions on HL Finance. Is that like something that, what's your take on that? I don't know if you're familiar with them. I'm not, so I can't make a comment on that. So
I'm vaguely familiar, but I think the question needs to be a bit more. If there's a particular part of Hong Leong Finance that you'd like to address, maybe that would be a bit more helpful.
Yeah, okay. It just says opinion on HL and banks in Hong Kong, Malaysia. Okay, another one is on potential M&A. We just touched on that with DBS, but I guess do you think that there are any attractive acquisition targets for OCBC or UOB? I guess, do you think that they could go out and buy something?
Definitely, if you look at, more particularly for OCBC, it's been in the news that they've always been on a lookout for something to acquire, and this is really fueled by their high capitalization levels. If you look at their CET1, OCBC is sitting on 15.5% CET1 versus the 13.5 to 14.5 of DBS and UOB, and this is already coming down from their peak of 16%. Previous speculated targets that they were looking at is in the Indonesia side, that being Panin Bank, Permata Bank, that has been taken up by Bangkok Bank. There has also been talks of them increasing their stake in Bank of Ningbo. They have 20% in it now. But beyond this, it's really their lack of communication as to what they are holding the excess capital for, whether it is for a return to shareholders or whether it is because they are seeing some potential issues in asset quality, or whether they actually have something earmarked to buy. So that is, that excess capital, that really gives them room to buy something quite substantial. And if you're looking at perhaps their optimal level is about the 13.5% range. And if you do a back count from 15.5%, there's actually about 4.4 billion Sing dollars in capital that they could potentially release, and it'd still be very comfortable in terms of capital. So $4 billion, nice, just enough to buy something.
Yeah. Okay, there's a question on targets in Hong Kong. I mean, I assume there aren't that many targets in Hong Kong. DBS sold out many years ago. I mean, they bought Wing Hang, right? Like OCBC.
OCBC bought Wing Hang.
DBS.
DBS got into Dao Heng many years ago.
Yeah. So I don't feel like there are that many substantial targets in Hong Kong just because of the size of the market. I imagine if there are targets like Shenzhen Rural Commercial Bank, they're going to be in China, right? For the big these guys. Yeah. Okay, cool. I think we are wrapped up there. I think we've kind of answered everything. I don't know if, I think for me, I guess I have one other question. I think I was quite interested in just getting your thoughts on, do you think that, with the digital transformation and trying to cut costs, I know cost income ratios are still in the sort of like mid 40s range for like all three. Do you think over the next sort of like 3 to 5 years with, I don't know, automation or digitization, that they can kind of get that down and cut out maybe some of the fat in terms of, I think that there's this impression that banks are very bloated in their cost structures and in terms of headcount, I guess. But do you think that with digitalization, there's going to be, a bit more streamlining in terms of the cost income ratio?
I think you would see some costs coming off. Anecdotally, if you look at DBS's disclosures when they split up their conventional banking and their digital banking operations, just for the consumer and the SME segment, they state that their digital operations, those command a cost to income ratio of 30 percentage points lower.
Wow.
So it's quite substantial from the mid-40s range that they're doing. But of course, the question then comes up, in the first place, if you're talking about cost and customer acquisition, how did they actually split it up? If the customer comes to the branch and they use an iPad, is that physical or digital? So I mean, those are things that have to be dissected a little bit more. But if that really is the case, and even if it's just half of that 15% percentage points, you could see quite a substantial amount of cost savings. But then in your time frame of 3 to 5 years, if they remain as they are, as in the conventional bank and the digital bank being housed in one entity, you might not see it as apparently. So I think if you want to capitalize on that savings, it's really a question of, does it then make it worth it to spin it out into a different entity and call it DBS Digibank?
But that's quite amazing. Yeah, the cost structure is definitely, it's a digital only bank, you can see why they're kind of gaining traction in other countries. I guess just the cost income ratio is so much lower. But obviously, as you said, you need to acquire customers, right? And I mean, I guess
also, at the end of the day, not many digital banks are profitable. It just
exactly, right? They're burning cash, and so I think
maybe another 5 years.
Exactly. Okay, cool. I think that's it for tonight. We've kind of wrapped up everything, and so thank you, Andrea, for spending the evening with us, kind of going through the banks and their earnings. And I've had a good chat, so I hope everyone has enjoyed themselves, and I think we'll sign off. So thank you for joining us, everybody, and good night.
Thank you very much.